Which of the following statements is false? 4 people missed this one, 4 people. Because there are 2 force excess capacity increases, so that's wrong. Economies of scale leads to less than proportional asset increases. That's correct, right? Lumpy assets leads to large periodic AFN requirements. So that is also correct. Accounts payable, accruals, and deferred tax is not included because they have no interest. In the calculation of cost of capital, the before tax cost of capital, that's wrong, right? After tax. So A and E. So either if you just chose A or E, either one is correct. So, but 4 people missed. So be careful. And then, like this one, let's continue our class. We did market weight, right? Market weight, and we assume other ones are just market. Then famous weighted average cost of capital. So weight, those weights are current market weight. So we use this market weight, 0.6, 0.1, 0.3. So 0.6, 0.1, 0.3, and all D, and don't forget only cost of debt, this tax matters. So after tax, 1 minus T. And other dividends are not deductible, so just no after tax adjustment like this. Then finally, we have 11.1%. So that is how to calculate WACC. So when you have 3 components, then just your cost of capital is weighted average of all the components, right? And weight should be how much of each capital you use. And your cost of capital depends on the amount of capital you use, right? So that makes sense. So that is WACC. Then what factors influence a company's WACC? Then what? Each component, right? Each component will affect WACC. So market conditions, especially interest rate and tax rates, definitely affect WACC. And the firm's capital structure and dividend policy, those ones definitely affect these W's, right? W's. And dividend policy definitely affects cost of equity. And the firm's investment policy, that is what? If you have riskier projects, then cost of equity will be higher, then what? Then you will have higher WACC. So each component will affect WACC. Then this is a kind of new topic. So far we use cost of retained earnings. That's cost of equity. Cost of issuing new common stock, this is also cost of equity, except that when you issue new common stock, then what? You have to pay flotation costs, right? So that's important. So you have to incorporate flotation cost. Retained earnings is your money, right? You don't have flotation cost. But issuing new common stock, then you have to just contact investment bankers. You have to print prospectus. You have to print the shares, all those costs, then what? That will just make your cash flow smaller because this flotation cost is cash outflow. So when you issue stocks, cash inflow, if people buy stocks, cash inflow to the company, but cash outflow is flotation cost. So that you have to include that. Also, this is issuing new common stock may send a negative signal. Why issuing common stock is a negative signal? Anybody? Why issuing common stock?
That maybe you need more funds?
Hmm.
Or like you're underwater almost?
Actually, the fact that you need money is not a negative signal because you may need a signal because you have lots of good projects, right? Mm-hmm. So like a growing company, they need a lot of money. So that may not by itself, that's not a negative signal. Good participation point. Why issuing common stock may send a negative signal?
Does it dilute the current outstanding shares?
Actually, that's also not to the point because as long as the stock price is correct, when you issue stocks, you get money, so it won't dilute, right? So your ownership, all the shareholders' ownership may be diluted, right? But price itself will remain if you just issue new shares according to the correct price. Then what? There are more shares, but more money. So more money divided by number of shares, same price, right? So that's not, again, good participation. Anybody else? This is important. For you to get money, there is from, so the very fact that you need money is not a, as I said, not a bad signal. But the very fact that you use common stock to get money may be a bad signal because you can borrow money and so on, right? Other ways. Then why issuing common stock is a negative signal? Because if their stock is undervalued, for example, they probably won't issue new shares, right? Undervalued, if they issue new shares, they get less than the right price, right? So they probably won't issue shares. So they issue shares whether the price is right or their stock is overvalued. So they want to issue stocks to get more money, right? So that's why people think that that's a negative signal, right? They, rather than borrowing money, they issue stocks because their stock might be overpriced, right? So they get just kind of free cash flow, free additional cash flow. So you can think this one also this way. That is, if your investment, for example, your new investment is really good, right? Then you want to borrow money and you want to keep all the profit yourself. You don't want to share your profit, right? You just, if you borrow money, you can only pay interest and all the profit will be yours, right? But if your investment is kind of risky and you don't know what happened, then what? You want to share the risk with new owners, right? Then you may issue common stock, right? So the kind of extreme example is that, let's say you found a gold mine, right? You need money to excavate, then what? You don't want to issue shares. If you issue shares, then all the profit will be shared with outside investors, right? In the case, you just want to borrow money and dig the gold and make lots of profit, and you keep profit yourself, right? So market will be suspicious when you issue stocks, right? So that may send a negative signal, right? So that may depress stock price. So that is a cost. So that is very important, but that's very hard to quantify. So when we just think about issuing new common stock, we generally only focus on this one, flotation cost, because there is a way to incorporate flotation cost when you calculate cost of equity. So like this. Cost of new common equity, we use RE, new. RE stands for equity, but we just differentiate RE with RS. So RE is with flotation cost. And RS is without. So for example, here is, look at this RS, right? RS is cost of retained earnings. See, RS, all those RS. We use RS, that is cost of equity, but this is cost of retained earnings, right? Cost for retained earnings. Reinvested earnings or retained earnings. So the RS is cost of equity, RE is cost of equity, but we differentiate RS for cost of equity for retained earnings without flotation cost, and RE is with flotation cost. So the formula for RS is that, so RS is, if you compare, RS is T0 times 1 plus G over P0 plus G, right? That is for RS, no flotation cost. But look at this. You use flotation cost is given as a percentage, so you use the formula P0 times 1 minus F, net price, net issuing price, net price. But that's the only difference. You incorporate flotation cost, then all the numbers are same as before. All you have to do is this, 1 minus 0.15, then what? Then, so 44.19 times 1.05 is 4.40, and divide by, let's store that at 1. Then 50 times 1 minus 0.15 is 0.85, 0.85. 4250. So 4250 divided by, we call 1. That is, so that's inverse of the answer, so 1 over x, 0.10, but plus 0.05, 0.05, 15, so you have to multiply that by 100, 15.35%. So this is due cost of equity, but don't forget this one. That is not RE. We are solving for RE, but that is RE based on DCF. That's important because for you to calculate RS, we had 3 ways. First way is CAPM, second way DCF, third way bond yield plus risk premium, right? There are 3 ways, and this is just one of them. So this is RE based on DCF method, right? So you cannot say that this is DRE, right? This is RE based on DCF method, right? So what you do is then you compare that one with RS. So we calculate flotation premium FP. So you have to be able to distinguish between flotation cost and flotation premium, right? Flotation cost is the cost associated with issuing new shares. Flotation premium is the difference between RE and RS based on DCF, because other method, you cannot incorporate flotation cost. So DCF way is the only way to incorporate flotation cost. So when you use flotation cost, it's 15.35. And when you use retained earnings, is 13.8. Then what? 1.55% is flotation premium. So finally, so that is flotation premium. So you add RS that you calculate before plus flotation premium. Then that is 15.55. And that RS is from this one. RS is 14%. There's RS. So that plus flotation premium, then you get 15.55. So when you use your retained earnings, your cost of capital is 13.8. But when you issue new shares, the cost of equity will go up because what? You lose money. You lose money, that is what? Flotation cost. So your cost of equity becomes more expensive by 1.55%. So that is RE. RE is, so final RE is 15.55%. So your WACC, due WACC, if one component changes, then WACC changes, right? So now, instead of RS, when you issue new shares, it will become RE. So WACC will go up, right? Just one component goes up, then our WACC will change. WACC will go up to 12.03%. So that should not be difficult, but many people miss this one. So you have to be able to distinguish between flotation cost and flotation premium. Flotation premium is cost of equity with flotation cost minus cost of equity without flotation cost. That's flotation premium. Okay. And then, so feel free to ask any questions to help your friend, not only help you only, but you're asking your questions, helping your friend.
Can you go back to slide 37?
Sure. Yeah.
What does it say? Does that say CF?
Yeah, CF, compare CF, or reference, cross-reference, CF.
Okay.
Yep.
Thank you.
Thank you for asking. Yeah, please ask any question. And then next topic is very important. That is an advanced topic. Is the firm's WACC correct for each of its divisions? Actually, in 304, we just calculate one cost of capital for the whole company. So any project for the company will be discounted by that cost of capital. But sometimes that's not fair. For example, if you have a conglomerate big company, right? They have many divisions, right? divisions. Then what? Then they may have different just characteristics of their business. For example, even though it is like car company, right? The main division is just selling cars. But some other division, they may deal with financing, right? And some other division, they may, even though it's mainly car company, they may just, the people use cars and then they may engage in hotel business. Or some division, they may use restaurant business. They use cars to go to restaurant. Then what? Even though it's car company mainly, the divisions may have totally different business. That's possible, right? Then if you have just one cost of capital for all the divisions, then may not be fair. So the answer is definitely no. The composite WACC reflects risk of an average project, but different divisions may have different risks. Divisions WACC should be adjusted to reflect divisions risk and divisions capital structure. The divisions may have their own capital structure. Then what? Then, just using one cost of capital to evaluate all the projects of the company is really detrimental to the company. So if you do just one cost of capital for the company, then what? Then suddenly risky divisions, their cost of capital is high, right? So cost of capital is high means what? Their projects generally have a high return by high risk. So if you just use one cost of capital, then mainly the risky divisions projects are all funded. But how about safe divisions, relatively safe divisions? Their projects are safe, so their returns are low. Because of having just one cost of capital, those safe divisions projects may not be taken, even though they are really good compared to their risk. And risky divisions projects, they are bad if you include their risk, right? But because of high return, you just take it. Like that is, the return is higher than your company's overall cost of capital. Then what? In the long run, you are selecting bad projects and rejecting good projects. Eventually, the profitability suffers and company may go bankrupt. So this is not good. So the correction is that you have to use the risk-adjusted divisional cost of capital. Risk-adjusted divisional cost of capital. So that is important, okay? So you have to make sure that your division has its own cost of capital, okay? Reflecting division's risk, right? So that is very, very important, right? That's very, very important. So we have to estimate the cost of capital that the division would have if it were a standalone firm, right? This requires estimating the division's beta, cost of debt, and capital structure, right? So the main point is that to do that, actually, you have to know division's beta, but you cannot get it. Why? Because beta is for stock price. The beta is for stock return, overall stock return, and that depends on company stock price. But each division doesn't have stock price, right? It's division, right? So that is not possible. So we use pure play method, pure play for estimating beta for a division, even for a project. That means what? Even inside the division, the projects may have different nature. Then you may have to just measure projects beta too, right? Then what? Then you use pure play method. How? First, you find several publicly traded companies exclusive in the division's business. So in this case, now if you want to calculate divisions beta, then let's say if it is finance division, then you just try to find the companies that deals with exclusive in finance business or hotel business or car business, restaurant business, right? So then use some average of their betas as proxy for divisions beta, right? But the problem is very hard to find such companies. That means for a company to have a stock price that is to be listed in the stock market, they should be a little bit big, right? Then what? It's very hard for them to engage in only one business. You may find it hard to find a company that engage in just one business, right? In that case, actually, there is a way. Then you may find out how much of the company's business is in that specific business, right? The weight. The higher the weight, the purer the company, right? So in that case, you may want to have some weighted average of this one. I'll talk about that later. So then what? But let's say we actually find 3 companies that engage in the same business as a division, solely engage in, that's why we call it pure play. Pure play means only engage in that business, right? Then form A, beta is 1.5. Form B is beta is 2.0. Form C, beta is 1.0. All different betas because beta depends on capital structure. Look at all different D ratio, debt equity ratio. So this one is 2 because what? They have a high debt, 0.7. This one is 1. This is low debt. So this is not actually representing business risk. This beta represents not only business risk, but also financial risk, right? So for you to get only business risk, you have to just unlever. Okay, this is leverage, right? You have to unlever. So that is this. To get unlevered beta, BU. So BU means beta, but unlevered means 100% equity beta. The formula is like this. We'll talk about more in chapter 15 and 16. This is Hamada's equation. We'll talk about that later, but we just borrow the formula. That is, the relationship is levered beta. This is levered beta, right? Levered beta means beta with some financial leverage. So when you borrow money, beta will go up, right? But that is just levered beta. This is L means levered. Levered beta. Levered beta or leveraged, same thing. Levered or unlevered or unleveraged, same thing. Unleveraged. Same thing, unlevered or unleveraged. So unlevered beta PU times 1 plus 1 minus T times D over E, that will be BL. So then to get from this equation, to get BU, BU is BL divided by 1 plus 1 minus T times D over E. So be careful, some people couldn't use this formula because you have to do this one first, okay? Multiplication first, so 1 plus that, right? So for example, if T is 40%, BAU, right, like this one, this is BL, right? This is BL. So the beta published in the financial publications, that is BL, levered beta. That is divided by 1 plus 1 minus T times D over E is 1 plus 1 minus T is 0.6, right? D over E is given, right? Somebody is 0.5, so that's 0.5. Then what? Then you have to do this first, right? So 0.6 times 0.5, 0.3. Then what? Now you add 1 plus 1, and 1.3, and divide by 1.5. That is inverse. So you put 1, you hit 1 over x, 1.05, right? So again, you have to just practice at home. Because many people miss this one in the exam. You have the formula, but some people just do it incorrectly. So 1 plus 0.3, so 1.5 or 1.3 is 1.15. Likewise, you do, you unlever all the beta 2 over 1 plus 1.42. This one is 1.12. Then what? Then you have 3 unlevered betas. That means what? This betas only reflects business risk because you unlever, right? So financial risk is gone. So this beta reflects only business risk. Then what? Then you have 3 numbers, so divide by 3. Why? Because we don't have any other information. We treat all 3 companies the same. But here comes real life application. That is, as I said, it's very hard to find a company that's solely engaged in that business. So in real life, you maybe this company A is, let's say, like 90% in that business, and this one is 80% in the business, and this is 70% in the business, right? Then you cannot just do simple average, right? You probably have to give more weight on beta of A, right? It's 90, very pure, right? So maybe you can multiply 1.15 times 0.9 plus 1.41 times 0.8 plus 0.89 times 0.7. And then what? Divide by total is 240%, so divide by 2.4, something like that. So that may be just application of real life. So if we do that, then what? 1.15 times 0.9, then 1.04 store 1 and 1.41 times 0.8 and store at 2, 0.89 times 0.7 and store at 3 just in case. Then add them up plus recall 1 plus recall 2. Then 2.79, but you divide that by total is 240%, so 2.4, 240. 1.16, if this is the case, then it is 1.15 times 0.9 plus 1.41 times 0.8 plus 0.89 times 0.7, all divided by 2.5, or then what? 1.06. Because this is very small, but it has less weight, and relative speaking, this has higher weight. The bigger one has higher weight, so you have 1.16. But this one is real life application and good for case study, but unfortunately, in class, we cannot just do that because that is extra information. So those ones are just for your knowledge. Okay.
So Professor, so the D over E is division over equity?
But that over equity, that
okay.
These, yeah, okay.
Professor, why did we divide it by 2.4?
The total weight is 90 plus 80 plus 70 is 240. So that is why. Yeah. That over equity.
Can you explain why we multiply by the 90%, 80%, and the 70%? Sorry, I missed that.
No, that is because the company A, they engage solely in that business, right? It's 90% in that business. And B, 80% in the business, C, 70% in that business. So A is purer, more pure or purer. So you give more weight to A, right? So that's why. So this is, as I said, real life application. But for your exam or quiz, we don't have that information, so we just divide it. So the reason we add them up and divide by 3 is that we just think that all 3 companies have same purity, right? They engage in, we're assuming they engage in 100% in the business. But in real life, that's very hard to find, okay, those companies, right? So you may want to adjust your estimation, and those percentages are easily to find, just public information, right? What percentage of their business is solely in that division's business, right? So that is some extra information. But so again, so this one is for your knowledge. So I put in just sky blue color. But in the exam, there is no such information, so just divide by 3. That's why, okay?
Professor?
Yep.
In your real life example, where on the, so say I'm looking at Yahoo Finance, where would I find that percentage of what they're doing business in?
Well, that is the company has, the divisional information. Each division has their sales, whatever, right? Then you may want to just use their sales as their size. So if they have company A has just 2 divisions. One is your division's business, the other one is something else. Then what? Sales, 90% of sales for the companies in this business, then you put 90%, something like that. Okay, so that is how to apply. Good question, application question. But for the exam purpose, just there is no, we have no way of knowing that. So if this is, let's say, a case study, then the case study has all those information, all those information, each division's size, whatever. And then once you get this unlevered average, then your division may have its own capital structure, right? Then now you re-lever, okay? You re-lever, right? So adjusting unlevered beta according to your company's capital structure, your company's TE, then what? Then you have this beta average, unlevered beta, and your, let's say your D ratio is 0.4, then this is like re-lever, right? Just leverage again, lever again. Then what? Then 1 plus 0.6 times 0.4, 1.24 times 1.15. Then this is your division's beta, including your capital structure, division's capital structure. Then once you get this one, then you will use CAPM, right? Famous CAPM. So, and to get CAPM, the RF should be given and RM should be given. Then what? Capital asset pricing model. Return on any asset is risk-free rate plus market risk premium times beta. So then 6 plus 10 minus 6 times division's beta here, the 11.72. But that is not the answer yet, because that is only cost of equity, right? Cost of capital include all the components. And let's say your WACC is according to the capital structure of the division. And then now you have to also know RD. Let's say RD is 8% and tax 40%. Then WACC is what? WD times RD times O minus T plus WS times. And that means they have no preferred stock, right? The formula is this WACC formula. Where is it? Here. This WACC formula is general one. This one is there when you have what? Preferred stock. If you don't have preferred stock, then WP is 0, right? No weight. So 0 times whatever is 0. So then your formula becomes WD times RD times minus T plus WS times RS, right? So if the like preferred stock is not given, you assume that there is no preferred stock. So then like this. So then what? WD times RD times minus T plus WS times RD times division. And be careful. This WD is dead weight, right? Dead weight, okay? Or dead ratio. It's not D ratio. So many people put this 0.4 times. That's wrong. That's wrong. Definitely wrong. So you have and 0.4 times this or 0.6 times that's wrong, right? Be careful. This is dead weight. So you have to be very careful about that. And I mentioned this once, but to make sure how to get D over E to D over total asset, right? Because D over E is D ratio. D over total asset is dead ratio. This is dead ratio. Debt ratio. And that is WD. Okay, not D is not WD, right? D is debt over equity. WD is debt over total asset. Then we have to know how to get that ratio from DE. This one, for example, this one, D over E is 0.4, right? Then long way is D over E is 0.4, so D is 0.4 times E, right? Then what? Then D over total asset is D over D plus E. Total asset is D plus E, right? But D is 0.4 E, so 0.4 E over D is 0.4 E plus E. Then what? There is a 0.4 E plus E. Then what? Then it's just dividing numerator and denominator by E, then what? 0.4 over 0.4 plus 1 is what? 0.4 over 1.4, right? This is more systematic way, but as I said before, by the way, as I said before, what should be the easiest way of doing this one? So D over E is 0.4. Then what is the easiest simple number to satisfy this equation? D over E is 0.4.
1.
1? Which one is, what is 1?
Denominator.
Check. So please complete your statement. So what is 0.4? You're correct, but please complete your statement. What over what is 0.4?
It will be 0.4 over 1. So that will be 0.4. Total asset will be 1.
Bingo. The simplest number is any number divided by 1 is that number, right? So you can use 0.8 over 2 over 0.12 over 3, all the numbers that satisfy this one, but the simplest one is 0.4 over 1. So you, from here, you simply know that from this one, so you just put D is 0.4 and E is 1, right? Directly. Then you save time rather than doing this way, you use just this is better to start. D is 0.4, E is 1, then what? Then D over total asset is D over D plus E, then what? D is 0.4 and E is 1, and then you get 0.4 over 1.4. Very fast, right? So that's the trick we did before when we talk about what? We did that before. Oh, yeah. Equity multiplier. Yeah, when we did the equity multiplier, we did that. So we just use the same trick. Just rather than going through all those equations, just plug in the number that satisfies this equation. So then what? Then you can just almost instantly get this one. So that ratio is 0.4 over 1.4. Then what? WS or WE is equity over total asset. Then what? Equity is 1 over 1.4, right? So that is just automatic. So that is how to get that ratio and equity ratio. So here comes this this one, 0.4 over 1.4 is from there, 0.4, 1.0. So there many people make mistake. Don't just put 0.4 times. 0.4 over 1.4 times 8% times 1 minus 4, 1 minus 0.4, 1 minus tax rate, plus 1 over 1.4 is debt equity ratio, times 11.72 is from here, right? That you calculate this one.
Professor,
Yep,
could you go to slide 47 just for a second?
47, yep.
Okay, thank you.
Okay. So then what? Then now, if you do that, then the answer is 9.74%. That is final WACC for division. So divisional cost of capital is 9.74%. And as I said, you can even apply this method to project cost of capital. If the project is really big, then you try to find the companies that engage in solely in that project and doing the same thing, right? So this is really good approach. So that's fair. You know what? Then your cost of capital matches the nature of your business or
So-
riskiness of business. Yeah.
Professor, so are we trying to, for the 1 over 1.4, are you trying to calculate the WD is a cost, is a debt, is it cost of debt, is a debt ratio? Is that what's it all about?
This is that ratio. Oops.
And for
Let's go
the,
back. So
for 47, you calculate WE is like equity ratio, is that?
yeah, good point. This is that ratio. That ratio. I can call it equity ratio. So that is simply WD and WS or WE, whatever. So that ratio, WD, so that is WD, right?
So WD and WS is equal to each other?
No, WD is that ratio. WS is equity ratio.
They're reciprocals. Well, no, not quite. Actually, you're right. Never mind.
Yeah, WD is that ratio. How much debt you have, in percentage in your cost of capital, in your total capital. How much debt you have. WS is what? How much equity you have in your total capital. Yeah, it's totally different. Or you can not totally different. Actually, they're related. So WD plus WS is 1. So WS is 1 minus WD, right? If you have only debt and equity, right? So that they have some relationship, not totally just separate, but they are in some sense related. Yeah. Any other question? Okay, then.
Where did you get the numbers for that equation? Was that like given or?
Which number?
The point or the 0.4 was given, right?
Yeah, 0.4 is given. Yeah.
Okay.
Okay. And if 0.4 is given, then all the other numbers are automatically you can calculate. Right? So all you need is D over E. Then what? You can calculate that ratio and equity ratio accordingly.
Okay.
Yep. Okay, good question. Next one. Then next way is accounting beta method. You know that each division doesn't have a beta because they don't have stock price. So we use pure play method. But now accounting beta method is instead of stock price, use project's ROA and S&P index ROA. This is market ROA, right? Market average ROA. And then what? Rather than you run your return on stocks against market return, you use return on asset against return on asset of the market, return on asset of the project, and return on asset of the market. And then if you calculate beta that way, but they are correlated, but only 0.5, 0.6. So it's not very accurate. Not only that, it's very hard to get data, right? And on new projects ROAs before the capital budgeting decision has been made. It's very hard. But this is, the point is that this may be a way, but it's very hard to get it. But if you get it, then you can use this one. But even though you use that one, the correlation is only 0.5, 0.6. So it is better to use pure play method is better. Then final concept, marginal cost of capital. Marginal cost of capital is marginal means the cost of the last dollar of new capital that the firm raises. Marginal means if you raise one more dollar, what should be the cost of capital? The concept, right? It's like your marginal tax rate, same thing. If you make more money, one more dollar, then what should be the tax rate on that income? Same thing, marginal. One more dollar, then what should be cost of capital? So marginal represents some change in cost of capital, right? Marginal. So that's a concept. So marginal cost of capital, MCC, right, rises as more and more capital is raised during a given period. That is, if you raise more capital, then what? It becomes more risky. So cost of capital may go up. Or if you raise more capital and if you have to issue new shares, and there's flotation cost, so cost of capital goes up. So this example is such that ABC company, RD 10%, RS 14%, and RE is 15.55, right? RS and RE is both cost of equity, but RS is without flotation cost, RE is with flotation cost. We just differentiate. So those numbers are given because they expect 100,000. See, so it's additional dollar. That's the point, right? New dollars, less dollar of new capital. So that means you have expects means you have new dollar in retained earnings over the coming year. So that means it's like very, very important that you have to first understand what's going on this way. New slide. It's like this. The main assumption is that the company tried to maintain optimal capital structure. We assume that they know their optimal capital structure is equity 60% and debt 40%, right? So this is, let's say, optimal capital structure. The point here is that we assume that they try to maintain this optimal capital structure as much as possible, right? Because this optimal capital structure gives the company the highest market price. So far, they maintain 60-40, right? like let's say, so 60-40 is just an example. They try to maintain 60-40 capital structure. But now here comes due capital. So you have additionally, you have 100,000 in, equity. Then if you have 100,000 in equity, what will happen to the capital structure?
Sir, what was the question?
The question is, currently, the company is maintaining 60-40 capital structure, right? Then now you will have 100,000 more. See, you expect you are going to have 100,000 more in equity. Then what will happen to this capital structure?
So retained earnings is gonna rise up more, and debt is gonna be decreasing.
Oh, the direction is correct. Debt is not decreasing, but that weight will decrease, right? You're right. The amount maybe stay the same, but the weight of debt goes down because you have, equity goes up 100,000, then debt has to go up to maintain this one. If not, debt weight will go down. Then final question is, how much of debt should go up to maintain 60-40 balance? Anybody? By the way, we'll quiz 1627, so 427. 427 is the quiz. So please let me know if you remember 426. So we'll start quiz on time.
66,000.
Great answer. How did you do that?
I figured 40% was 2/3 of 60%, so I just multiplied 100,000 by 2/3.
Great answer, Roger. That good point. Because for you to maintain 60-40 balance, you have to maintain 60-40 balance for additional just cash, initial cash. So 100,000 is 60%. Then how much has to be debt like this? So 100,000 times, this is 6, so it's times 6/4, 4/6, then what? As you say, 66,666.67. So if you have here 66,666.67, then total is what? Then total will be, just ignoring the previous dollars, total will be 166,666.67. Then what? Then if you have 66,666.67 divided by 166,666.67, 40%. So we maintain this 40%, right? So that is the just assumption behind this like analysis. But so given this one, now it's easier for you to understand this breakpoint concept. Breakpoint is dollars of low cost capital divided by fraction of the capital in each capital structure. That means if the optimal capital structure is 60% equity and 40% debt, then all you have to do is dollars of low cost capital, that is what? 100,000. Why this one is a low cost capital? Because this is cost of retained earnings. That is lower than what? Cost of new common stock. Cost of new common stock involves flotation cost. So that's why it's low cost capital. Divide by its weight, 0.6. Then 16667. That is exactly this one. So you see the value of this formula. Breakpoint formula is that you can calculate total just cash flow, total capital that you have before your cost of capital changes. It's like this. That is, one more slide. It's like this. From 0 to 166, 666, 17, you are gonna use retained earnings, RS, right? And RD. Your cost of capital is RD and RS. Why? You can use your retained earnings, right? And then you have just also 66,066 debt. So total is 166. And this is not one, this is breakpoint, BP. And after breakpoint, you no longer have retained earnings, so you have to issue new stock. So you have to use RD and RE. Okay, that is important. After breakpoint, you used all low cost capital, that is retained earnings. Then issue new shares, the cost of capital goes up. So that's the importance of breakpoint. So the point is this. In this example, it's very easy to think that since you expect 100,000 in retained earnings, so after 100,000, you have to issue new shares. Wrong. Why? Because of this optimal capital structure maintenance. So you have to maintain optimal capital structure. When equity goes up 100,000, then that has to go up 66,000 to maintain the capital structure. Of course, in real life, that may be a very strong assumption, because in real life, companies don't adjust the capital structure that often, right? But we can think of this one as a long term. That is what, in the long run, company is trying to maintain that optimal capital structure, because optimal capital structure makes their stock price highest. So if we think about long run, long term, that's why we call it target. Optimal capital structure is also target capital structure. So currently maybe off, but optimal capital structure is our target to go there. So in the long run, we try to maintain. So in that sense, it makes sense. So we just don't forget this one. When you solve this problem, make sure that you automatically increase that amount to maintain, just very important, to maintain the optimal capital structure. That's important. So you have to issue you bond or you borrow money like this. So total will be this. An easy way to calculate that is this breakpoint. So after this breakpoint, cost of capital change. So marginal cost of capital 1. There is further capital raised from 0 to 166,667. Then look at this, lower cost of capital, RS. So those numbers are still from the previous slides, 10%, 14%, and you get 10.8%. Marginal cost of capital 1. But after breakpoint, that is after this one, you have this components cost go up 15.55, reflecting flotation cost. So your cost of capital goes up 11.73%. So that is marginal cost of capital. So marginal means cost of capital change according to how much capital you raise, right? But this one is limited because we have only included equity capital. But if you have a debt schedule, then it's like this. If you borrow up to 1 million, this is less risky, so cost of debt 10%. But 1 to 2 million, then it's 11%. And 2 million won and above has become more risky, right? The company may have more bankruptcy cost than what? 12%. In that case, actually, there are 3 intervals, right? And 3 interval means 2 breakpoint. That is $1 million up to $1 million, then low cost of capital is 1 million. And their capital structure weight is 0.4, right? Then 2.5 million. And second breakpoint is 2 million, right? Then 2 million divided by capital structure weight, 5 million. So it's like this. First breakpoint is 2.5 million. And second breakpoint is 5 million. So we have what? 3 intervals, 1, 2, 3, right? So always interval has one more intervals than number of breakpoints. So 2 breakpoints, then we have 3 intervals. If we have 3 breakpoint, then 4 intervals. Likewise. So now we now combine just equity breakpoint and debt breakpoint. Then it's like this. Then it's like this. The total is like this. You have breakpoint, but it's E means breakpoint for equity, right? Or more consistently, like equity breakpoint, 166,666.67. And then you have breakpoint for debt, but first one, that is what? 2.5 million. Now it's another breakpoint, a breakpoint for that, but the second breakpoint, 5 million, right? Then you have what? 4 intervals. Then just a more systematic way of doing this one is, then for each interval, which cost of capital is relevant? For example, first interval, just original RD, RD1, and RS, right? This is before equity breakpoint. So this is equity breakpoint. So RD1 stay the same, right? Because it is not that breakpoint. So that cost of that doesn't change. So it's still RD1. But after equity breakpoint, you should use RE, right? And then after that breakpoint, then cost of that will change. So it's RD2. But this is that breakpoint, so cost of equity stay the same, RE. And after the third breakpoint, this is still that breakpoint, so cost of that goes down. So RD3, and so RE is still the same. So RE is just, this is that breakpoint, so RE, equity, cost of equity is the same, like this. So now you have to apply just each interval. So marginal cost of capital 1 is WD times RD1 times 1 minus T plus WS times RS, right? This is the first interval. And marginal cost of capital 2 is WD times still RD1. This is equity breakpoints, RD1 times 1 minus T plus WE times RE. Why? Because equity breakpoint, so equity change from RS to RE. And MCC3 is WD times RD. Now this is what? RD2. Why? Because that breakpoint is RD2 times 1 minus T plus equity stay the same. It's just sometimes, of course, the breakpoint could be both D and E. It's this possibility, right? Depends on numbers. Then what? Of course, after that breakpoint, both cost of debt and cost of equity changes. But for this example, the equity breakpoint and debt breakpoints are different. So just that breakpoint, only that cost of debt changes. Finally, MCC4, WD times also that breakpoint, so RD3 times 1 minus T plus WE times RE, right? So that is how to do this problem systematically, right? I recommend this way. Then it's easier to think and just handle this problem. So MCC1, MCC2 is already we calculated, right? From previous, this one, right? Then MCC3 is what? Look at this. Now it's new debt, right? And look at this, new debt. So all you have to do is just calculate, plug in the numbers, right? Then the final question is like this, new slide. Then draw the MCC schedule. Like this, then what? Draw, so you have to draw a graph. It's not difficult, it's like this. The first breakpoint, 166, 666, 167. Second breakpoint, 2.5 million. And third breakpoint, 5 million. Of course, this is not on scale, so we have some breaks here. Then what? Then how to draw is pretty easy. From 0 to here, there is this MCC1. And there is what? 10.8%. And from 166,662 to 2.5 is MCC2. That's 11.67. And from 2.5 to 5 million, MCC3. That will be 11.97%. Finally, after that, so this is the final answer. So draw the MC schedule. Just draw according to the number you have, right? All you have to do is just use it accordingly. By the way, 11.76. We have 11.73. Which one is correct? So 15.55 times 0.6. Store at 1. 0.24 times to 2.4 plus we call 1. 11.73 is correct. So this is wrong. So 11.73. Oops. So I have to change it. 1.73. And then this one should be 1.73. So that is how to draw MCC schedule. So it is not difficult. So if I give you, so this is a completed problem like this. If I give you this one, and if I give you that schedule, right? And then the question is, draw the MCC schedule, then you have to calculate MCC1, MCC2, MCC3, MCC4, and just draw a graph like this. So it is not difficult, right? Any question? So that's the end of chapter 10. So chapter 10 homework due after spring break. So that is 3:30, 21. Okay, you have more than a week to do that.
You mean Thursday, April 1st?
No, you have a whole week.
Break.
Because
that's spring break.
Don't forget that spring break you have to study. I told you that my first, whether I told you or not, but my first finance exam, I scored below average. So I study my whole spring break only finance. When my people went to beaches and enjoy spring break. But I study whole week.
Spring
Then
break.
what? Yeah, spring break, I study whole week. And after the spring break, the second midterm exam, I got higher than average. So I was very happy. So I study more. And then what? In the final exam, I got the highest score in 2 sections, MBA class 2 sections. Huge number, about 300 people, highest score. That's why I'm here, right? That spring break changed my life. So I hope you study hard. So actually the due date is what? Next
April
Thursday.
1st.
Yeah, no, due date is next Thursday. But
First time, Professor.
it is spring break. So I'll give you whole week of study and homework due Tuesday after spring break, right? March 30th.
We have to
So
quiz.
don't try to, try to study, okay? Especially those who got low score in the midterm exam 1.